Welcome to the Collective Genius Podcast, the show for real estate investors who are looking to scale.
Welcome back into the Collective Genius Podcast. Good to have you as always. My name is Leon Barnes. I am your host as always. And today we have another one of those Collective Genius members. This is where investors come to grow and scale their business. Today's member is Mr. Marcus Crigler from Springfield, Missouri. How you doing, Marcus? Good to see you, my friend.
I'm good to see you. Good to see you, man.
So, short story, real quick. When I first came back to CG, in this seat 7 years ago now, the first person that I met at my very first meeting was Marcus. We're both sitting there watching, both Chiefs fans. I grew up in Kansas City. And Marcus is from Springfield. I sit down at the bar, and I am next to this guy. Don't know him, never met him before. Wasn't a part of CG when I was a part of it before. I'm like, you a Chiefs fan? Yep. What are you here for? CG. Huh, me too. You were the very first person that I hadn't known prior to that I met. Small world. It's weird how that worked.
Weird how that works. And we've connected with the Chiefs ever since. We've been texting about their Super Bowl runs over the last several years. No matter what the audience members think, we have accumulated some championships lately. So I'm pretty proud of it.
Me too. And, it's funny, you've made it when all of a sudden a team that no one cared about when you were a kid, all of a sudden is the team that everybody hates. So I know that we've created, a dynasty, because only in that sense do I know that no one hated the Chiefs when I was growing up in the 80s. No one, why would you? There was no reason in the 80s to hate the Chiefs. Now they do. That tells me that we were doing something right.
That's exactly right. You're loved until you're hated. That's how it works.
No doubt about it. I want to make sure you get a proper introduction here. Speaking of dynasties, you are the man, the financial backing, the financial background for people that want to build dynasties and scale their businesses. You are a service provider within this group. Beck CFO is the name of your business. And so for those that are listening, you know that we have members that are real estate investors, and we have service providers that provide a service for real estate investors, and also most times are real estate investors themselves and know the industry. Marcus just happens to be fractional CFO and CPA for real estate investors only, and has been in this group now for 7 years. And I wanted to have him on because, there are really 5 main challenges that I see on applications. And one of those 5 is financials, is making sure that you have consistent, predictable revenue. And there's been some changes, obviously, here recently that I wanted to have Marcus on. Did I do you a good service there, Marcus, with the introduction of what your business is?
Absolutely. Knocked it out of the park. Like a pro.
So just to give a little bit of background there, what is it that you do with real estate investors? Just give a quick summary so people know what we're talking about to start off here.
Yeah. I mean, everybody tells you that you got to have an elevator pitch, right, when you start in the business world. So our elevator pitch is pretty simple. We help people make money, save money, and build wealth, right? And so we do it through our accounting firm, CPA firm that, again, you mentioned it. We work with real estate investors across the nation. And more specifically, I say real estate investors, but I like to disclaim that with real estate entrepreneurs. We work with people that are in the business doing it every day. We have some people that, just invest passively in real estate, but that's not really our core focus. Our core focus are business owners in real estate, right? And so a lot of the people that are probably listening to this podcast are the people that we work with. And we do, everything. We have 4 core kind of divisions, if you will. We have tax planning, right? We have tax preparation, which are 2 different things, by the way, and we may touch on that a little bit. We've got accounting, which is, getting your books done. And then we've got CFO services, which is really strategizing about your books, right? So you've got tax planning, tax preparation, accounting, and then CFO are the 4 services we offer that kind of help us achieve our goals.
So I think it's important to get this out of the gates. There are a lot of people that may be listening to this and say, hey, I have a great CPA and that helps me with one of those four that you just mentioned there, maybe the accounting side, but may lack strategy, or they don't, work specifically with real estate investors, specifically real estate investing entrepreneurs. What would you say the biggest difference, not knocking anybody in their services, but what would you say is the biggest difference between someone that works daily with real estate investors in your industry versus someone that doesn't?
Yeah, I mean, it's no different than when you go to the doctor and you go to your family physician, right? If you have an ache or a pain, you go to your family physician and they say, hey, you've got cancer, right? You're done talking with your family physician, right? You now go to a specialist, and that specialist might even have other specialists that they need to focus, send you to. And so we're a specialist, right? And so when we look at our business, we had a couple different opportunities when I started this thing. We could niche locally, where we focus on local entrepreneurs, local business owners, and focus there. Or we could get in a niche as far as an industry and look at it nationwide. And, long story short, I fell in love with real estate back when I started in this CPA world. And so not doing real estate was really not an option for me. So I knew I wanted to have a real estate focused business in the CPA world, and I had to do that nationwide. And so that's kind of how we got here.
How long have you been specifically working with real estate investors?
Well, let's see. So, I should say, Beck CFO has been open since 2020. We started in the middle of the pandemic. Before that, I was a part of a company, Duckett Ladd, which is another, we talked about being specific. They're dental specific, right? And so, I actually heard from them last week. We sent a dental referral over there. Sure, we could have serviced them. We could have done a all right job. They're experts. They know things about the dental industry we don't know. So, that's kind of where we align, is we're kind of those experts. So anyways, we were kind of in two different spots. They were dental. There was a dental piece of the firm and there was a real estate piece of the firm. And ultimately the two partners that were there, they wanted to go and execute on the dental side. I wanted to execute on the real estate side. So I started Beck CFO and CPA. So even before 2020, I was doing it for about, I think it was 2017, 2016, when we first started in that real estate entrepreneur specific niche. Before that, we were in multifamily housing at that time.
So I asked that for a very specific reason. What we're going to try to accomplish during this pod is Marcus has a bunch of resources, and I just wanted to make sure that everyone knew, what Marcus focuses on and specializes in. He's a surgeon, not a general practitioner. And so there's a lot of resources that he's going to provide today on a couple different things. Obviously real estate investing, I'm going to get down that road here a little bit, but also there's been some changes that are for 25 and also 26 that you may have heard of in the news. And I watched a presentation recently that Marcus did for our community with the big, beautiful bill. And he's going to share that here today as well as part of the pod. So he's got some resources that come with that. So I want to make sure I set up and edify Marcus of why he's an expert to be able to speak on these things. And I would be remiss if I didn't start off with the low-hanging fruit. I recently did a podcast where I was speaking to someone about, hey, I know these are not usually the questions that I'm going to ask, but these are questions that I most often hear. And so they may not be the best questions, but they are the answer. They are the questions that most people want an answer to. So if you have to clarify with let me break that question down a little further, then you go ahead and do that. So let's start with the first thing before we get into the big, beautiful bill and the changes that real estate investors need to be aware of. What's the most common? You've won a belt for a CG presentation on the 10 most common business practices that your highest level clients consistently do across the board. I want to start on the other side. What is it that people miss the most as they're scaling, these are real estate investors that listen to this pod. They're listening to it because they're looking to scale their business where no matter where they're at today. What's the most common mistake that you see on the financials?
I think I hit it in the beginning, and maybe this will help clarify that. You do have to understand that as a real estate entrepreneur, you are not a real estate investor. Those are two different hats, right? And so one of them is a cash generation tool. One of them is a cash multiplication tool. But let's talk about cash multiplication, right? If you are multiplying cash, you must have it first, right? And so what I see the most common issue is that we start investing and trying to multiply something we haven't created, which is cash. And so the ones that, and the reason why Leon's asking that, he's seen this presentation a few times, so I know what he's getting at, and he knows my answer here, is the reality is the most successful real estate entrepreneurs have cash, and the least successful ones are consistently trying to find it. And the reason being is that they're always in that scarcity mode because they never know when the next check's going to come. And when you struggle in scarcity mode, you lose all opportunity. That's the big key. When you're in scarcity, you'll miss out on opportunity. And you eliminate that by having the appropriate cash reserves.
This is, it's not anyone's fault in this space, but most people that become real estate entrepreneurs didn't necessarily start in real estate, right? They started in something else and they read a book. Very common one amongst real estate investors is, the book that everyone mentions on this podcast, Rich Dad Poor Dad, and talks about obviously growing wealth. Unfortunately, what that breeds is a zero-sum game. And why I say zero is because as you were saying that, all I could think about is even kids that are starting out with multiplication, their easiest multiplication to start out with is 0 times 0 equals 0 plus times anything is 0, right? And we see that a lot at the select and elevate levels where someone's saying, hey, I'm growing my wealth, but I'm struggling, with my cash conversion cycle. I just don't have enough to pay the bills. And it's, you have to feed the fire first. And I know this is, this goes back to what Jason always talks about is discipline. But most people starting out, they don't have that discipline because they don't know until it's, until it becomes a problem. So if there's nothing you take away from this pod, it's obviously multifamily and self-storage and single family assets, all the assets that a lot of our members own. They don't necessarily own those, especially out of the gates, from a cash flow perspective, right? They need cash, active income to multiply to wealth. Correct?
Yeah, no, that's exactly what it is. I think, so we talk a lot about this process in our business where, as an entrepreneur, you're going to go through 4 main phases. You're going to go through the hustle phase, you're going to go through the secure phase, you're going to go through the expand phase, and then ultimately where we all hope to get is to the exit phase. And so what a lot of people do, and especially in the real estate industry, but I only know that because that's what I focus on. So maybe it's in every industry, maybe it's every entrepreneur, but what I see a lot happen in the real estate industry is we try and go for the expand and exit phase before we finish the secure phase. And the reason is security is boring. It's boring. Security is where we're getting all of our books together, right? We're getting all of that stuff that nobody likes to do. Security is making sure we understand those books, right? Security is making sure our taxes are filed on time. Security is making sure that we've got enough cash in the bank. Security is making sure we don't have all these credit card debts, right? All of the stuff that is instead of putting our money into growing our business, we're having to put it into solidifying our business. But what the wealthiest and what the most successful figure out is that is simply the foundation that if they do it once, they never have to do it again. And now you're in this expand and exit phase and you never end up back in the hustle phase. And so what most people are doing that spend their years and years struggling in this industry is that they go from hustle to expand, hustle to expand, hustle to expand until they finally figure out, hey, I got to hang out here at the security level to get my stuff together through after hustling, right? Because hustle's just making money. Like, we just got to go make $1. There's nothing I can tell you. If you don't know how to make revenue, I can't solve a problem, right? Hustle's getting that solved. But once you go from hustle and you just try to expand that and grow it and try and buy all these houses and have your acquisition team and double your marketing spend and all these things, but yet you haven't done the little things that build that foundation, you're going to end up on that cycle. And that's that rat race that we talk about.
And I never thought about it this way until you just said it. And I've heard you say this before, but I wrote it down and I'm thinking to myself, it's the model of what the collective genius is now. Not when I met you 7 years ago, but what it is today. There are 4 different levels for a reason. We're trying to meet you where you're supposed to be, not where you think you're supposed to be, right? Meet you with the education at that given time to help you expand to the level that you want to get to. Because the first thing I typically hear from the hustle folks are, I want to scale, but man, I'm looking at multifamily and I'm looking at these other things that they've never been in before. And we have set up specifically the flow of the collective genius now to meet people where they're supposed to be at that given time with Elevate, Select, Premier, and CEO. CEO is our exit strategy group. It's where people are not necessarily wanting to sell their business, but operating as if they will in the future. That it to a T. I never even thought about it until just now. Glad you mentioned that.
Yeah, no, it's exactly right. And I think, it's how the process works, right? It's not, we didn't make this up. We just happen to have, the same process built around the same methodology because that's what entrepreneurs actually go through, right? And so, what your goal and our goal is no different. Beck CFO and CG is no different. We have the same goal outcome. Help people get through that process as easy as possible. That's it.
So during this phase, as people are growing, the thing I love about you and your services, Marcus, is you are Midwest nice, but at the same time, you are also Midwest direct. And so the strategy play, I love that about you. In fact, our good friend Jimmy Vreeland often tells me when I'm calling him, he's like, I'm sorry, I was just getting chewed out by Marcus. I get that conversation quite often.
Sure.
I love the fact that during your strategy sessions, you're not telling people what they want to hear. You tell them what they need to hear. So you do offer like the fractional CFO services and things like that. As people are starting to grow, they don't necessarily have the budget to bring on an executive and a CFO. It's super important for people to have strategy and a chief financial, even if it's fractional. Can you speak to that more as you help people navigate those waters?
Yeah. Well, I think first off, it goes down to our core values. So we're a pretty simple company. I'm a pretty simple guy. Our core values are truth teller, others first, in pursuit of excellence. And so that truth teller piece of it is that Midwestern honest, right? Is I don't beat around the bush when there are things going wrong in the business that need to be identified. And I expect my team not to beat around the bush when there's things going wrong in the business that need to be identified. And sometimes those aren't easy conversations, and I don't always like them. I don't, to Jimmy's point. Now I give Jimmy a lot harder time than I give everybody, but because Jimmy's been on here before, so yeah, everybody knows Jimmy. So if you know Jimmy, you know what I mean. But nonetheless, I think you got to have that transparency and you got to have that honesty between your financial team and your executive team. And so from a fractional standpoint, we've kind of come into it at multiple different levels, because the reality is we don't see that every client needs Marcus in their books hands-on on a regular basis. Not everybody's running the business of Jimmy Vreeland, right? Or needs that type of level of executive. But what we do find is that most people need some sort of feedback on their financials. It is one thing to get a set of books done and your balance sheet is clean and your P&L is clean and you got a cash flow statement. Maybe you got some custom reports, maybe even a dashboard. But if you don't know what it means and you're not reviewing it, then, that's where you start to run into some issues, because just getting it done is not really the goal. The goal is to be able to utilize it. And so as we're working with entrepreneurs, we're working with those people that are in those same phases. And some of them, they just need a dashboard sent to them with a Loom video once a month. And they don't need somebody to come in and spend an hour and a half with them going through all of their business segments. But some people do, right? And some people need that higher level of where, hey, we got weekly cash flow issues that we need to be managing every single week and forecasting and figuring out, okay, are we going to have enough money next week or are we not? Right? And some people, need that hands-on help. But I will tell you, everybody needs that service, right? Whether it is getting done internally or getting done externally, you need to understand your financials. You need to be able to do some sort of projecting of where you're headed within your financial future. And that sounds complicated, but that's just putting together a few weeks worth of your known data, right? And trying to do your best to guess at it and get better, right? None of us do any of this stuff great the first time, but once you start the process of, doing that's what most people get scared of. That's why I'm hitting on that, Leon, is most people get scared of, okay, how do I forecast into the future? Most people are like, I can look at my balance sheet. I can look at my P&L. But where they get stuck is, okay, well, what does this mean for the next month and the next month and the next month? Well, go in and start doing some of that forecast. And I'll add to the resources, Leon. I have a 52-week cash flow forecast that I will also add to the resources that we do at the end here, so that they can take that and utilize a 52-week cash forecasting tool in their business if that's something that would be useful.
Absolutely. We'll take all the resources that you can provide. We'll have a nice URL for everyone here at the end as we get into some other things here, but we'll make sure that all of these resources get on that document, and obviously the show notes as well. Shameless plug here for not only you, but also for the Collective Genius. We have found especially for those investors that are just starting that scale. What I mean by that are really hiring a team, building out systems, process, core values, all the things that businesses need in order to grow a solid foundation. We have found financials is one of the biggest hurdles and biggest challenges. And so we have Marcus every fifth week now. We started out every month, and now it's every fifth week, where Marcus will come on and look at a specific challenge that he might be hearing, like most recently did the Big Beautiful Bill. But these are issues that real estate investors, not only his clients, but in general that he hears from CG meetings, that are going through, these type of challenges and how to overcome those. It's just an information call that we do every fifth week, and we've been doing now for 4.5 years. There's tons of, I am not a professional CFO or CPA. And so we always rely on those that are experts in the field. And it's awesome to have. So basically what we're going to do here is a small training call that you do every fifth week, because I do have a few more follow-ups, and then I want to get to that Big Beautiful Bill, because that's what everybody obviously is talking about right now.
Sure.
Challenges right now, as we sit here, summer of 2025, any specific challenges that you're hearing from real estate investors on the financial side?
Well, I won't say that there's any specifically identified challenges. Here's what I'll tell you. And I was speaking to a gentleman that you and I are both friends with earlier today, and they asked me a very similar question. They said, "What are you seeing in the market right now?" And I said, "Well, here's what my diagnostic is of your type of investor. And let me give you a little bit of background on what this type of investor is. This is somebody that probably does about 100 transactions a deal, both a year, both flip and wholesale, probably generates north of 7 figures in profits a year." Okay. So this is the type of person that we're looking at. This is the type of person that either you might be in Elevate or Select and looking to be there, or you might be in Premier or even CEO. And that's, well, I'm talking exactly to you. But anyways, what I've seen for that person is that in 2022 and 2023, even they were able to scale in a large way. And when I say they were given a lot of opportunity to scale, and they seized it. And in 2021, even 21 through 23, there was a lot of great opportunity to scale, and they seized it, and they should have. What happened in late 23 and 24 is that some of that scale we realized was not effective scale. It was not long-term scale. It was to meet the current demand of the market. And so 23 and 24, we gave back some of that profits that we saw. What I've seen in late 24 and 25 in that market segment is an understanding of how to work in the new market, right? So we adjusted. It took us a little bit to adjust, because anytime you scale up, it's much faster. And this is something that's important for your listeners to understand. It's much easier to scale up than it is to scale down. It's much faster to scale up than it is to scale down. And so once you scale up, you might scale up in 6 months, but it may take you 18 months to scale down, because we don't run Fortune 500 companies that go in and chop people's heads off. That's just not, we're all small business owners. We typically operate delayed. And that's just how it works. And so what I've seen is that flip of where, okay, we've got businesses operating in probably a more normalized market with sustainable profit margins that I think have long-term sustainability. I think the reality is there was short-term sustainability, and we all knew that in the market we were previously at. And I think we're back to, some sustainability within the market that we've got, at least within our customers' profitability.
I'm so glad to hear you say normalization, because, over the last few years, I've heard this downturn, and guys, this is just a more normal market that pre-2000, really about 2018 and before, this was a normalized market. You actually had to work to sell that flipped house, or to get a renter in at the rate that you want to get them in. All these things that we're talking about from a cash flow perspective of my buyers are more picky on the dispo side. Well, that's not a 2020 or 2021 market, which we haven't seen really in my lifetime at that level. So I'm glad to hear you say normalized. There are obviously some changes coming down the pike, and this is another great reason to have, someone like Marcus on your side, is we're always talking strategy. Like, if you're going to grow and scale the business, that's not something that you just keep your head down and keep hustling through. That's part of a phase, but that's not a long-term phase. So in order to do that, you have to be preparing for the future, and also look at opportunities that present themselves. And as I was looking through, what most real estate investors want to know about right now is how they're affected by the big, beautiful bill, both 25 and 26 and beyond, what's coming down the pike with this. I think that, it's easy to get caught in the headlines of tax, tax cuts. But I think what I saw today, and I listened to your webinar as well, and I went a little bit more into it today. I saw some opportunities that may present themselves for the investors that obviously understand the resources within that bill now law. So first and foremost, I want to make sure that everyone understands that Marcus is going to supply a webinar for all the podcast listeners. We'll have a URL up for him, and I'll have his webinar on there. So he's going to go a deeper dive on this, but I want to kind of do a high overview of let's start with 25. Well, what are some of the changes that real estate investors should expect and understand from the bill?
Yeah. And so first off, what I will tell everybody is as an entrepreneur, I have gotten to the spot in my business to where tax is not my main focus. So I have a tax partner. This is what they do every single day. Caden Hackney is an expert on this tax bill. So I'm going to do my best to do it justice as we talk about it on this podcast. But as Leon mentioned, we have a webinar that you can have access to. Anybody that's listening can have access to. They can go through the webinar. Caden deep dives. I think there's even some Q&A in the webinar as well. So really good information and strategies, not just information, but there's some strategies in there that you're going to want to dig into and understand. But so I think here's the headline. right? Here's what everybody's talking about. This is what everybody should be excited about if you're a real estate entrepreneur. And really, I'm going to just back that up and say, entrepreneur in general, you should be excited about this bill. Now, I will tell you, there are things that aren't so sexy about this bill that we could talk about. So, just be aware of that. But what's the big thing? What is everybody talking about? And what does it mean for you? Well, this is the 100% bonus depreciation, right? And so let's just take a step back and actually figure out what all that means. And why it is important as a real estate investor to at least know what it is and the consequences of using it and when to use it, why to use it, how to use it. So depreciation, let's just back up to what depreciation is. Depreciation in the tax code is simply a law or an expense, I should say, that will allow you to write off an asset that is not necessarily depreciating in value. So it could be depreciating in value, by the way, but it's not necessarily depreciating in value. The IRS puts a term on each one of these types of assets. And so when we're talking about real estate's a really tricky asset class because we all know over time real estate increases in value, but the IRS says, hey, you can take a piece of that real estate expense every single year against your income if you want to keep that piece of real estate as an investment. And so that's super cool. Like if you just look at that in and of itself, you're like, oh, that's a pretty good deal. Like it's appreciating. I get to expense it. Cool. But what bonus depreciation says is, hey, I can take more of that asset that is getting expensed over a period of time, and I can take more of it in a shorter amount of time. So maybe it could be more of it in 15 years. Maybe it could be more of it in 5 years. But then they came out with 100% bonus depreciation, which means you could take more of it in the first year. And so what we see, and this is, we'll do an estimate here, but what we see is for every $100,000 of real estate assets purchased, we see about a $25,000 tax deduction once you go through a cost segregation and bonus depreciation process. And so it could be a little bit less than that. It could be a little bit more than that. But one of the things that you'll notice there about that number, and this is why it becomes such an interesting topic, is that your deduction tends to be about the same amount as your potential down payment for that property, which means in essence, your down payment is being deducted and you are getting tax savings on that, right? And so you're getting a $25,000 tax deduction. You got to put 20%, $20,000 down on the property because you get a loan. You get $25,000 worth of deduction and you only had $20,000 out of pocket, right? And that's if you actually put money out of your pocket. And we all know all the strategies about burring and not having to, and seller financing and sub 2 and all those creative strategies if you're not a traditional, 20% out of your pocket type of person. And so that's the big news, right? And so what's really cool about that is, and here's the when you should use it, right? This is where you combine tax strategy and wealth building. I have a lot of clients that will, make a couple $100,000, and then their goal is to buy a bunch of properties to get their tax bill down to nothing. Okay. Well, the tax code right now says a couple $100,000 if you're married you're in about the 20% tax bracket, which means your effective rate is in the teens, which means the overall taxes that you pay is in the teens. So when you go buy a piece of real estate, that benefit that you get for buying the real estate is maybe a smaller amount. But once you start making, let's say, $600,000 and you end up in the 37% tax bracket, now you go buy a piece of real estate, and that piece of real estate, you are paid to keep the piece of real estate. And let me give you an example. This is a fun one if we've got time here, Leon.
Yeah,
so
plenty.
So, and this is, I'll say this. This is kind of where we made our name back when the original Tax Cuts and Jobs Act was enacted in 2017. Because we saw the math behind if you wholesale the property versus keeping that property on your books, you can keep more cash by keeping it on your books because of the tax strategy. Now, you have to be in the 37% tax bracket. Why? Because when you are getting deductions at the 37% tax bracket, you get 37 cents off of every dollar that you spend. Versus in the 19% tax bracket or the 15% tax bracket, you only get $15 off for every dollar that you spend. And so what we found is that our highest income earners that were wholesaling and they were flipping a lot of properties, what they weren't doing is they weren't calculating what it would look like to hold that property. And so we would do these calculations, and I've got one in this big, beautiful bill that you guys will see if you guys go on and check that out, where you've got a wholesale fee of $30,000. And after tax, right, because that wholesale fee is going to get taxed, you're going to have a taxable event there. You're going to keep about $18,000, right? Whereas if you kept that property, put it in your rental portfolio, tuned it up a little bit, got it worth what it needed to, got it in your portfolio and flipped it into your portfolio, I guess I should say, and got it to the fair market value it needed to be, and you depreciated that property, your depreciation expense would save you $20,000 in taxes. So to sell the property, you keep $18,000 in cash and you don't get to keep the property. Or you could keep the property, save $20,000 in true taxes, not just deduction, but save $20,000 in taxes, and you have a property on your books. And so that is the power of what we just got introduced to with the One Big Beautiful Bill. That's what everybody's excited about. But you also have to understand the value of that bill gets larger when you are in the higher tax brackets, right? If you're in the 20% tax bracket, let's make some more money, right? Unless there's other reasons to keep the property, right? There's plenty of other reasons to buy and hold than taxes, right? I'm saying if we're going to utilize taxes, and taxes are going to be a big piece of the strategy for buying a property, let's do it when we're at that high level. We've saved enough money. We've got the reserves. And the cool thing about this is that's this tax bill will accelerate your wealth building and your portfolio building if you do it in the right order. If not, you might end up in a spot where some investors are, where they got to sell some of it back.
Again, this goes back to strategy. Clearly, this is something that, you've dealt with before, obviously 2017. Things had changed in the last administration, and it was down, correct me if I'm wrong, it was down to 40%. This brings bonus depreciation back up to 100% starting when, and one follow-up would be, in that same scenario with 40%, the example that you gave before, just for some context, that example of the 100,000 that you gave was about 25,000 in current before this bill. What would have that savings been compared to today at 100%?
Yeah, so that deduction would have probably been somewhere, I'm going to guess $7,000, right? So, it's a massive deal, right? $7,000 to $8,000, maybe a little bit.
Yeah.
And so the date, here's the funny thing. This is, you love Trump or hate Trump, you got to appreciate the marketing behind it, right? And so the bonus depreciation takes effect on January 20th. January 20th is Inauguration Day. So that's when he actually took office. And so if you bought a property, not if it was in service. So a lot of us, if you've talked tax strategy before with your advisor, there's an in-service date that's different than the purchase date. We won't get into it. Just talk to your tax advisor. But what the law says today is that, hey, if you bought a property prior to me taking office, sorry, you're under 40%. Or if you did it in 2024, you're under 60%. So unfortunately, if you decided to buy a property in the first 19 days of this year, you are subject to the 40% bonus depreciation. Otherwise, after January 20th, it will be the rest of the year. Now, I will say this. There's going to be some changes to this bill. They're already talking about changes to the bill. I wouldn't be surprised if this is one of them, right? Because I don't think this is a hill he's going to be willing to die on. And I think it's just kind of a point being made. But that's just an opinion piece. For right now, that's what the rules are, and you should plan on that.
Okay. Outside of bonus depreciation, that's the big one that everyone, at least that I know of, especially in the Collective Genius, was asking questions about. What are some other high-level things to take away from this bill?
Yeah, so really important stuff that maybe doesn't get a lot of the big headlines, but I think most of us will appreciate. First off, our overall tax brackets have been lowered. And so the more money you make, the less taxable income or the less taxes you will pay on that based on the current tax brackets versus what they were going to go back to. And again, on the webinar, you'll kind of see the pre and post, but ultimately each level of income, and if you're not familiar with tax brackets work like this. The first, let's say $10,000 worth of income is taxed at 10%. And then the next, let's say $50,000 worth of income is taxed at 15%. And then it goes up until we get to the 37% tax bracket. Well, what the tax bracket adjustments did was that it moved those rates up. So now maybe 10% is from 0 to 15,000 and 15% is from 15 to 100,000 and so on. So that improved everybody's just taxable rate, no matter what income that you got. On top of that, another gift that we got was the standard deduction. Previously, what we were going to see was a standard deduction that would have been for a married couple $12,700, which means you would have a significant reduction in your standard deduction, which about 80% of the country uses when they're filing their taxes. And again, if you don't know what the standard deduction is, it's a free gift from the government for earning income. And so the government says, hey, if you're single, we'll give you a deduction of $15,000. Well, if this didn't pass, it was going to be $6,250. Well, that's almost a triple, right? Or $6,350. The married filing joint is a $15,000 standard or $30,000 standard deduction versus a $12,700. So again, you're getting a free deduction just for earning income. And I think no matter if you're in the 37% tax bracket or if you're in the 10% tax bracket, that is a welcomed benefit. I mean, even at a 10% tax bracket, that saves you $3,000 in taxes, right? That deduction there. So those are, small things not getting a lot of press just because, it's kind of not super sexy, but it is a nice benefit. And you didn't have to do anything, right? We don't have to go buy a property. We don't have to go buy a cost seg. We don't have to do bonus depreciate. We don't have to do any of that. It's just a gift. Here's another good one. This one is maybe one of the most important ones that we got gifted back that I thought was going to get taken away or had the potential of getting taken away. And that was the qualified business income deduction. And so for some of the listeners, you have no idea what I'm talking about, and that's okay. You probably get it no matter what you do. It's kind of like a standard deduction for businesses. However, for what you should know is it is a 20% of your profits deduction for your business. And so you might have been operating over the last couple of years, getting that deduction, not even knowing it, because if you make less than a few $100,000, you just get it kind of automatically if you're in the right industries. Okay. So 20%. So let's say you make $200,000. That's a $40,000 deduction for you. It's not terrible. We'll take it, right? That had the potential of going away and sunsetting over the next few years. They turn that into a permanent deduction, which means if you are an entrepreneur in this country and you make, again, less than a few $100,000, it's like $300 and something thousand right now, then you can qualify for the 20% qualified business income deduction. If you're over $300,000, you have homework. And that homework is to ensure that you are getting that 20% deduction on your qualified business income, because once you get over that threshold, you now have qualifications that you have to meet in order to get that 20% deduction. So let's say you're that business owner that's making $1 million a year. That 20% deduction is worth $200,000 in tax deduction for you. You don't want to miss that, right? And so that qualified business income deduction is crucial in making sure, number one, if you're less than a few hundred grand, we wanted to keep it. Great deal. But if you make more than a few hundred grand, then not only are you glad we kept it, but you need to make sure you're utilizing it to its fullest ability. Because that, I will tell you, this is where we've made a ton of investors happy and a ton of entrepreneurs happy with coming and working with us, because it's literally a couple calculation and a couple changes to your filings, and we can maximize out that 20% deduction if you're missing out on it. And we see that missed all the time. So we're super excited that's back, right? So a lot of these things are not things that are necessarily completely new, but they're extensions and permanent extensions of what has existed and what we should have been taking advantage of all along. And so now, if you haven't been taking advantage of it, look at it as a reset. Look at it as a new opportunity for you to go look at all the strategies that are out there and start maximizing those within your specific sector. What do you think? I got a couple more. A couple more we can mention.
Yeah, please do. I just want to pause there for 1 second and just
Sure.
emphasize the word strategy multiple times. You said it multiple times, and I'm going to say it multiple times. Strategy, strategy, strategy. There are so many things that we don't know as entrepreneurs. The old E-myth, right? We just know what it is that we do, and not always do we understand what is beneficial to us, because we don't consult with the experts, the specialists, the surgeon versus the general practitioner. You owe it to your business to make sure you have someone looking at these type of things for your business, because think about what he just said. 20% on $1 million is a lot, and they're making sure that they're utilizing strategy to legally take full advantage of what the law allows. So again, just want to reemphasize that strategy, because there are a lot of people I hear, talking about they're picking up pennies while stepping over dollars, because they just don't seek out I don't know tax well, and I am not afraid to say that I am getting better at it. I am continuing to read upon it, but this is where experts come into play. Even if you know it well, you do your genius zone and let Marcus and people like Marcus that are strategists do that side of it. Give us a couple more high level things for real estate investors that stand out, Marcus.
Totally. Well, I'll add to that too. I think you hit something that not a lot of people realize, and it does make a big difference. And not only is this a big difference in your, being a well-rounded entrepreneur, but it really makes a big difference in your success. And that is understanding what the tax code is actually telling you, and understanding what the financials are actually telling you. It is, hiring us is great, and you should hire us, but you should hire us to be educated, not simply to do it for you. And so and by the way, don't hire us, hire another firm, but you should hire them with the expectation that you're getting educated, not just them doing it for you, because there is so many things within the financial world that it's your option whether to do X or Y or Z. And you need to know, do I do this tax strategy, or do I make this financial investment, or do I do this, and what are the repercussions of it? Not just, hey, I'm going to do this because somebody told me to do it, right? That's the wrong thing to do. And eventually that will catch up to you, right? And so what I highly, highly recommend is that, yes, you should seek out professionals that know this, but you should make sure that you understand it at least to a basic level, so that you can ensure that you're not getting into stuff that you don't realize, right? And so that's something that we see a lot.
Yeah. Real quick add to that, Marcus. Like I look at the difference between the levels, and when I'm looking at expand and exit, to your point earlier of those 4 different levels, the expand and exit, they know the code. And when they're asking you questions, it's to get a better understanding at your level because you live in it. They're not clueless. They understand it. And I've heard you say, which is hard for most entrepreneurs to hear, is I've heard you say the best strategy for you is just to pay the tax in this particular case because of X, Y, and Z. And here's why. Like, you're explaining why going and buying a bunch of rentals in this particular market may not make sense for you. Like that example you gave earlier, the best strategy may be this year you just pay the actual tax.
100%. There's plenty of strategies. I'll tell you this story because this is kind of a fun one. You know, I get to work with some really great entrepreneurs. It's really, really interesting. And, you know, my wealthiest entrepreneurs are on two sides of the coin. Okay. One side of the coin is that they spend a ton of time understanding tax and working through their tax strategy and ensuring that they pay the least amount in taxes as possible. And they're super successful. And a lot of people listen to those people because they are the ones that are like, you know, tax strategy sexy, and, you know, nobody wants to pay anybody more than they have to, especially not the government. And so, you know, everybody loves that. But there's another side of that coin, and that is the people that spend their time making money and just pay the tax. And I have clients that are in that world too, and they just want to know they don't want to spend time strategizing and having to step over dollars to pick up pennies. They want to just go execute their business and write checks and make sure that they are compliant with that process. And beyond that, don't talk to them about tax. They're just make the money and pay the bills. But super successful people on both sides. I will tell you the ones that are the least successful, the ones that play the middle. Hey, I kind of want to do some of the I kind of like some of the strategies. But I'm not really saving for my tax bill. And so I'm like right here in the middle. So like either get really, really good, get a tax team, understand it yourself, start planning for taxes, or get your checkbook out. Both of them can be super successful. There's not, you know, that's the reality. That's the truth behind it.
I think you and I, you know, follow sports because it relates so well to business. And if you look at the most successful organizations, they have a strategy. They don't play the middle. Now, the strategy, there are different formulas to win, different strategies to win. But generally, when you're riding the line is when you have a very middle of the road type of organization. And to use this as the analogy, a business that is not really focused on the one thing, which is, like you said before, in order to have issues with taxes, you got to make money first. Let's get that strategy figured out first, and we can move on to the other things.
Totally.
Got a couple minutes here left. We're going to go over all of this on the URL that I'm going to provide here in a minute. The webinar, the 52-week forecast. I mean, there's a bunch of resources that Marcus is going. I just want to make sure that we don't gloss over any other high-level things for real estate investors in that big, beautiful bill.
Yeah, a couple of things I just want you guys to be aware of. You guys, again, you can look at the webinar, you can go Google it, you can YouTube it, plenty of information out here, but here's some things you need to be aware of. Opportunity zones are back and they're here to stay. They're going to be great if you understand how to utilize them. For most people, it will not be a good opportunity. But for some real estate investors, probably those ones that are in the expand and exit groups, right? The premier and CEO groups inside of CG, or you would qualify for those groups, and you like to, and wealth building is a big piece of where your focus is right now. Opportunity zones are where you need to look. A lot of great stuff there. Some things that aren't I'm going to give you one more good and then I'll go into some bad things. One more good is that we got another gift, and that was the estate gift tax exemption. And so for a lot of us, and this didn't get a lot of press, is, it was going to, if you don't know, when you die, there's an inheritance tax. It's about 40%. And if you die with over a certain amount of money, they tax everything above that roughly 40%. Well, what the bill was going to do, if this didn't get put in place, was bring that number down to like $5 or $6 million. Well, the current with current net worths today, $5 or $6 million is really not a ton of money in the grand scheme of things. Now, some of you guys may listen to this and say, Marcus, you're out of your mind. I get it. I understand. But you have to also understand that we're also working in a world where there are more millionaires now than there's ever been. Okay. So you also have to understand that that's the world we're also in. And those people, you may be on this podcast, or you may soon to be in this position where they were going to be above that $5 million threshold, and their total estate plan was going to be in big, big trouble. And then now we've got some risk. Now it's like 15 million. And so, and that might not even be the right number, but it's significantly more than what it is today. So that's been a really nice benefit. I don't have that number right in front of me here, but that was a really good benefit for us as real estate entrepreneurs, especially when you look at a 30-year plan. You buy a house today, it might be worth, $250,000 in 30 years. It's going to be worth $1 million. Well, you're going to have a lot of equity in that. That's how we talk about, building a $5 million net worth. And so for those of you that think, $5 million, that's so much money, I can't even comprehend it. Yes, you can. You'll get there. Just understand it takes time. And so, so those are the great things. Couple bad things. Let's talk about some issues. If you are a high income W-2 earner, or you have income other than business income, you need to know about the excess business loss deduction, which limits the amount of losses, even real estate losses, that you can take against that income. So you need to know that. High income earners, that's a big deal. That got permanent extension in the bill, which means forever you are going to have limitations on the amount of losses you can take in certain situations. This is going to mainly impact high income tax earners. No, not mainly. It will only impact high income tax earners. And then lastly, another downside that was a permanent downgrade was we all get these itemized deductions, right? So we talked about the standard deduction moving up to roughly $30,000. But if you have deductions in excess of that $30,000 that qualify, then you can take those more of those deductions. A lot of times that's going to be like charitable deductions. You and I both know really charitable people. They like to give away a ton of money. And so they take these huge write-offs as charitable deductions. Well, as high income earners, there's actually some limitations now that could limit those high income earners from being able to take that deduction in the current year, because you are only allowed to deduct up to 30% of your income as an itemized deduction as a high income earner. So it's not all good, right? There are some there's some downgrades in the bill. We have in the webinar that you guys are all going to go watch, because I know you're just dying to go watch it. It's going to start by talking about how we have a client that this year versus last year, 24 to 25, they will pay $250,000 extra dollars in taxes because of this tax bill versus the last tax bill. So while we're listening, you might be listening to this and say, hey, Marcus, these are all great things. We're going to never pay taxes again. I will tell you that is not necessarily the case. You should get that tax planner, understand what your risks are, and ultimately go and attack them, right? And so I'm glad in July, I know that taxpayers got a big tax problem, and we're attacking it now.
Well said, my friend. So many great resources, so many nuggets given during this pod, not just for the big, beautiful bill, but all of that information. We're going to line up a URL for you. It's specific for Marcus. It's Marcus Crigler, and that's Crigler, Marcus Crigler .thecgpodcast.com. All the resources that he shared, obviously we'll have those in the notes as well, but the actual webinar and all the 52-week planner, he's going to send all that to me. We're going to put it on that URL, Marcus Crigler .thecgpodcast.com. So much great value there, my friend. If people outside of, they're going to see all your information, I'm sure, on that webinar. But if it takes them a little while to get to that webinar and it takes time to do that, how would they, is there a place that they can follow you, the firm, and potentially reach out if they're interested in learning more?
Yeah, totally. So beckcfo.com is where you can go reach out. We've got a ton of resources on there as well. We're always putting new resources on there, so you can go look around, see if there's anything there that can help you in your business. If you think that you might be looking for a CPA and we would be a good fit for you, let's sit down. We've got a little free consultation that you can sign up for and get a little bit more information about what we do. 15, 20-minute call. And if that makes sense, then we'll take the next steps from there. So super simple to work with us. If you don't ever want to look at my website, go follow me on Facebook. I don't do Instagram. I don't know how to do Instagram, by the way. I'm learning that. But Facebook, I put a lot of stuff on Facebook and try and give as much free content as I possibly can. So if you just want more content like this and you like the financial side, this is what I'm talking about on Facebook all the time. I'm pretty passionate about it.
Marcus, you are the oldest young guy I know. You have Facebook still at your age. That's interesting. Well, at least, you have Facebook with no Instagram. That's interesting because
I have an Instagram. I just don't know how to really use it. I think there's posts that go on the Instagram, but I'm not. If it's going on Instagram, you could rest assured I did not put it there. I'll be honest.
For clarification, just in case, it's beccfo.com. There's no K on that back. It's beccfo.com. Marcus, it's been a pleasure as always, my friend. Always great catching up with you. Always tons of value shared anytime we're having a conversation. And this one just happened to be with the listeners, both on YouTube as well as wherever you get your podcast. So thank you, my friend, as always. And we will see you. So here's what we're going to do. I know this. From here on out, as we have any tax changes, this may be a quarterly thing if you're okay with that.
Absolutely. Anytime you need anything, you let me know.
Awesome. Well, if you'd like to be in the room with members like Marcus Crigler, obviously you know how to do that by now. We have a website, explorecg.com. That's where you can find all of our information on all the tiers that we were talking about earlier, the hustle, the secure, the expand, and the exit. Those are all Elevate, Select, Premier, and CEO, all available to you. You'll find an application at that website. Fill that out, and you have an opportunity to talk to myself or someone on our team about, is this the right fit? And if it is, we'll talk about next steps from there. Again, all the resources that Marcus supplied today are at marcuscrigler.thecgpodcast.com. Go and check those out. There's a ton of good information on there. Marcus, thank you again for supplying all of that. We will see you next week on CG, the podcast.
Are you ready to scale your real estate business? Visit thecollectivegenius.com, where real estate investors come to scale. Subscribe to the Collective Genius podcast and hit the bell icon to be notified when our next episode releases. And thanks for listening.